Welcome to Uniquely Charleston, the podcast that gives you an insider's look at Charleston real estate. I'm Currie McCullough, the broker in charge of Uniquely Charleston Properties, and I'll be your guide as we dive into the trends, strategies, and local insights you need to succeed in this market. Whether you're buying, selling, or investing, I'm going to bring you expert interviews and real-world advice to help you make the smarter moves. Welcome to Uniquely Charleston, a podcast about real estate and all things real estate in Charleston. And I'm joined today by Michael Squatrito of Leeward Mortgage. Michael, welcome.
Hey, Kurt.
Thanks for being here.
Glad to be here.
We want to know all about how to buy a house in Charleston right now. Everybody's kind of in sticker shock, so I thought it would be great to have a mortgage person come on. One of the things that you and I chatted about recently was the difference between mortgage brokers and mortgage bankers. I was wondering if you could explain a little bit about that.
I'd love to. There's a big difference. Traditionally, especially in the Charleston area, most home buyers are assuming, hey, I'm going to buy a home, I need a mortgage, I'm going to go to my local bank. That bank, they have one set of guidelines, one underwriter, one set of interest rates, whereas your broker is able to shop and really tailor the program to the buyers themselves. And there's a lot of different programs out there that different lenders will be willing to offer that banks just either they don't have the risk threshold for it, or most banks are funded by Wells Fargo, a Bank of America, so they have a lot of additional requirements that we just don't have to worry about on the broker side, so we can get a lot more creative.
I love that. I'm so glad you said that because honestly, I always recommend that people use brokers just because you think about like the stereotype of banker's hours. I think a mortgage banker is somebody that goes to the office, and when it's 5:00, he closes the office and goes out and plays golf. And you guys work as hard as the realtors do in that if anything weird comes up, you're trying to form a solution. And whereas your mortgage banker, no offense guys, might just send a letter out that says denied. So,
and that's what I like is, for our company as an example, it's 5 people and we're not closing hundreds of people's loans per month. So you're getting to work with a dedicated loan originator, a dedicated processor, and we're with you from start to finish where, a lot of the bigger companies, they kind of just pass your file down the line and you're calling asking for updates and they don't know what's going on.
Do you recommend that people touch base with you just like maybe even a year in advance? Like how early do you say if you're thinking about buying a house, your lease is not up for another 6 months, what's the best time to start the process?
It's never really too early. Obviously there's certain things that we want to do at certain times, but look, we're always happy to, hey, here's the roadmap, here's how we can get you on the path to home ownership. And especially if someone's working on their credit or they're saving up for a down payment, I would say sooner the better. That way we can go over your goals and make sure that the plan is going to work for the timeline that any given home buyer would like to have.
Okay, so what's the smartest thing you can do if you're thinking about buying a house in 6 months?
So we got to look at credit. The first thing I always look at is, hey, we don't want to be making any big purchases, but especially borrowing. We don't want you to be taking out any excess debt on your credit. One big thing that underwriters are going to look at, we call it a debt to income ratio. And all that means is how much money are you making per month compared to what are your total debts per month. Okay. We don't want to mess with that.
What's coming in versus what's going out.
Yeah.
And I think it's like 30%.
We can go up to close to 50% now, depending on the loan.
Okay.
But everyone has a horror story, myself included, of someone who's under contract and makes a purchase, maybe buys furniture for the new home on credit, and it pushes them above that number.
Yeah.
The new car. Yeah. That's the big one.
Nobody told me not to go out and buy a car. Yeah.
And we see that, obviously it's something we talk about to everyone about at the beginning, but I get it. You're buying a new house. I want to repaint the walls. I want to renovate a room, but the best thing you can do is...
The furniture thing is the big one.
Furniture is the big one.
Wait till you close.
Yes.
Don't spend any money until you close.
Exactly.
All right, so I've got an example that I wanted to talk about today. And it just came up with me recently because I've got all these college kids that are graduating college, they're starting their new life, and they're having to live in Charleston. And it's really expensive here.
It is.
So I manage some properties for some clients that are good clients, obviously, that I really, really like because property management is tough. But I do it as a favor, more or less, for some clients. And we're getting like $5,000 a month for minimum for a 3-bedroom downtown. I end up with 3 young adults living there. It just kills me that they're spending $5,000 a month paying my client, every month instead of getting any equity. Mm-hmm. So it occurred to me the other day to talk to someone like yourself, who's a mortgage broker, about how those young people might get together and buy their first house.
Yeah, so a great option is potentially they come together, they form an LLC, and now their first home, maybe it isn't technically a primary residence and it's an investment property owned by a company. And now we're lending to the LLC, which is the buying power of 4 individuals who, look, they're just getting their start in life. We all remember where we were when we were younger. They can combine their total assets, their total income, and hopefully come up with something better. And we can use them all their income, all their credit history to create a stronger buyer profile.
Yeah. And then, for example, one of my clients recently decided to sell something downtown. Mm-hmm. He and his roommate bought it when they were at the College of Charleston in like 1992. I think they paid $120,000 for it. It was a duplex. They lived in one unit. They rented out the other unit. At the time, obviously, things were more affordable in Charleston. They were able to pay it off in 5 years or something, and then just cash flowed it for the next, 25 years. And then I sold it for them for $1 million. So they basically each made $500,000 after making all this money every year as a rental property, and just having it as a kind of a cash producing income, stream.
It's a fantastic investment. And especially for someone who's just getting out of college. I mean, if you're looking at creating a nest egg for a future family or for future goals that you have in life, real estate, I don't think there's much better an option than looking at a potential house.
Yeah, they basically say that it's the easiest way to build wealth in America. Yeah. I mean, and I don't always recommend that people buy. There are situations where it's not a good idea. I have a client who came to me one time and she said, my sister needs a house, but she's not capable of maintaining a house. Don't try to sell her a house. Just find her a rental, because she's not a person who can remember to take her trash out, much less change her air filters. You know what I'm saying?
I do.
This person is not good candidate for home ownership. However, most people probably are, and paying rent is literally throwing it away, right?
I agree. I mean, what I tell people now is there's a lot of conversation about interest rates. Your interest rate on a rental property is 100%. You're getting nothing from your monthly payment. You're paying someone else's mortgage.
That's a funny way to look at it. Right? Yeah, but it's so true. It's so true. 100% interest rate, right?
Exactly.
Yeah.
So, I mean, especially with what you're mentioning, I mean, we always like to see people invest in themselves, and that's what a home is. Mm-hmm. Especially when you look at, I think the number is something like 72% of Americans qualify for some type of house. Mm-hmm. So to your point, I mean, the numbers are more people we'd like to see looking at home ownership.
Yeah, just to make our whole economy more stable in general. Yeah, it's good for everybody. Okay, so talk to me a little bit about ways of getting into a home and not taking a bath on the interest rate.
Yeah, so there's a couple different ways. Rates are close to a 2-year low as of today, which is great. Our 20-year average for interest rates is just above 7%. Mm-hmm. So we got a little bit above that on the high. We're getting below 7s into the mid 6s, but there's a lot of power to do what we call buy down a rate right now. Mm-hmm. There's a lot of bang for your buck and say, hey, I qualify for a 6.875% rate, but with just a little extra money, we can get it down to the low 6s, even the high 5s, mm-hmm. which when you're looking at a monthly payment, it's going to save you so much. And there's a huge bang for your buck when you're putting down, a minimal amount as opposed to, say, for a down payment.
Okay, well, I'm going to make you do some math.
Let's do it.
Which is my least favorite thing in the whole wide world.
Well, hopefully I don't disappoint myself.
Okay, so I want to buy a $500,000 house. Yep. And I've got, let's say 20 grand mm-hmm. in my savings account. What's the best way to approach that?
So if you're a first-time home buyer, the nice thing is you only need 3% to put down.
Okay.
So that's $15,000 on a $500,000 purchase.
So that gives me an extra 5.
Exactly. So for that, I would love to say, let's look at options as for a rate buy down. Mm-hmm. The extra 5% or the extra $5,000 you put down for a down payment, it's not going to affect the monthly payment that much. But if we're buying down, I mean, that's a full % of a purchase price that we're looking at discount points. You're probably going to save a half point in terms of interest rate.
And so give me a example, like my monthly payment would go from what to what?
So on a house like that, you're potentially, I would say, about $150 a month in savings for your $5,000.
Okay.
Compared to, say, if you put that to your down payment, $20, $25 a month, lower down payment.
Okay. So definitely better to buy down the rate.
Absolutely.
Yeah. All right, cool. And then, so as far as like with interest rates and house prices, right now people are like, I don't want to buy because the interest rates are high. What happens to the Charleston market? Spoiler alert, I know the answer to this. When interest rates go down.
Well, the nice thing is we don't have to speculate about this because we saw it in 2021 and 2022. And as everyone remembers, that's when we had a ton of equity increases and home price increases here. So what I talk to a lot of people who are waiting or saying, hey, I just want to see what happens with rates before I buy. We know it's going to happen. If rates come down, prices are going to go back up. It's just kind of how it
multiple offer situations are the worst for real estate agents, because then you're like telling someone, if you want this house, you can't do a home inspection. You're going to have to waive that. You're going to have to waive pretty much all of your rights as a buyer in order to be competitive if you aren't cash buyers. And then, you know, there are 15 offers that you have to beat out, and they have something called an escalation clause, which means that you can go up to X amount if someone else, which is basically just like, please take the money, all my money out of my bank account.
Exactly.
So yeah, way better than, in other words, to go ahead and buy a house when it's a less competitive market, pay the higher interest rate, maybe do the buy down. How long do you think it makes sense to own a house in this current world that we live in?
I'm all for home ownership as long as, you know, even if you buy a home as a primary, maybe it makes sense to turn that into a rental down the road.
And try to hang on to it.
Exactly. Every mortgage payment you make, you're gaining equity. And if you look at home values in America over the last 100 years, since we kept keeping track, they've pretty much gone up steadily.
Yeah.
So you're going to, if you hold on to it long enough, chances are see some appreciation on the investment.
I always say that it's like, if you look back at the history of Charleston, the only wrong move you can make is to not buy.
Yes.
So let's talk a little bit about when you're in a house already and you really want to buy another house and you're not quite sure how to organize that, because I'll tell you right now, a realtor's worst nightmare is somebody who says, I want to buy another house, but I can't buy it without selling the house that I'm in.
Yes. So we see that quite often, and a good way to get around that is what we call a bridge loan.
Okay.
Essentially what that means is a lender's going to lend on the equity in the house that you currently own. We're going to help you for the down payment on the next house using those proceeds. And that's going to let you get into the new home that you're wanting prior to selling your existing property. And then obviously when your existing property sells, that bridge loan is paid off. So most people have that debt extended 30 to 45 days. It's a pretty short-term loan that lets you get into the new house without and you know better than me, the hassle of listing your house while
you're
seeing
still
other
living
homes.
in it.
Yeah, too.
Yeah, I mean, it makes it harder for us to be competitive as marketing. You know, negotiations are really difficult when you're kind of hamstrung, because if you come up with something wrong with the house and you want to negotiate, but you've got your house under contract and their house under contract, and you have the timing has to be perfect, you're going to default on one person or the other if you have any issues. It's just the worst. So bridge loans make a lot of sense. They're not terribly expensive either, are they?
They're not.
Okay.
They're not, especially when you're only making 1 or 2 interest payments. The cost, most of the time when we look at it, it's more than worth.
So if you're in a situation, which I've been in before, where you're like having to not ask for repairs that might be as much as $20,000 because you're in that situation where you can't, literally are stuck not being able to negotiate.
Exactly.
Then it's definitely better to go ahead and do the bridge loan.
It gives you so much more.
Move into the new house and then sell your own.
Yeah, so much more flexibility.
Okay, great. I'm so glad that exists.
Yeah, me too.
Well, this was a great conversation.
I agree.
Thank you so much for joining us today, Michael. Next week, we're going to be talking about trends in housing We're also going to be talking about the dreaded condominium. Never a fan of a condo. Michael, you're probably not a big fan of condo lending either.
It's a little different here, that's for sure.
Yeah. Obviously, we've all heard about the dockside fiasco, so we'll delve into that a little bit. But stay tuned, everybody, for more information about Charleston real estate. That's it for this episode of Uniquely Charleston. Thanks for listening and being part of the conversation. If you found this valuable, be sure to subscribe so you never miss an episode. And if you're thinking about buying, selling, or investing in Charleston, reach out and I'd love to help. Until next time, stay smart, stay sane, and stay uniquely Charleston.